What's up, everybody? Friday, January 4th, 2019. Well, the stock market, as of right now, and I guess we got about 20 minutes left until the close this Friday. The Dow Jones is up 735 points, completely erasing yesterday's decline, which I said was a total overreaction. You know what's funny? Some of the comments here, market's down 600 points. I get people posting up, yay, it's down 600, LOL. Like, that's totally juvenile. Listen to what I say. Try to learn something. Try to educate yourself. Try to become informed. I mean, some of you, I just wonder. You may be in the middle of doing something. Who knows? You might be making love to your wife or your girlfriend, and you see the market's down. You come running to post up a stupid comment like that. Listen to what I say. Try to learn something. Get educated. Now, yesterday I sent out an email with, as I always do before the jobs report, because I do my own forecasts, and as I have mentioned many times, what's important in those forecasts is not necessarily to hit the number on the head, but to find out, to determine how much of a deviation away from the consensus, because that's what moves the markets. If it comes in at consensus forecast, you're not going to get that much movement in the market. And where I have been extremely accurate is in informing my followers and subscribers the deviation from the consensus forecast. And in my email yesterday, I said it was going to be a strong number. I think my forecast was 216K. It actually came out at, 317, 100K higher. But the consensus forecast was 177K. So I had that right. I said stocks were going to rally. I said bonds were going to come down. Now, the interesting thing about bonds is that up until yesterday, everybody in the world out there, including Fed officials, with the exception of myself, except for me, they were talking about recession. They were talking about maybe the Fed was going to have to stop raising rates or even cut rates. As a matter of fact, you could see priced into Fed fund futures for the January 2020 FOMC meeting, there was actually a 39% probability of a 25 basis point cut and a 16% probability of a 50 basis point cut. Needless to say, those probabilities went way down today, and ultimately they're going to evaporate. What also is going to evaporate is the notion that the Fed is done raising rates. Now, they're probably not going to raise rates in March. You know, they are a creature of the market, and they're also a creature of commentary. They read the news, and, you know, they get affected by that. But you will start to see an erosion in the sentiment that the Fed is done. And what this means is it is negative for the bond market. The bond market trend, the long-term trend of lower bond prices, higher yields, still is in effect. We are not going to have a recession, as is very clear, not only in today's data of 317 on the payrolls, but I have been saying for a long time that the numbers just do not bear out the amount of extreme pessimism that we have been seeing in the markets, whether that be the stock market, whether that be the bond market. The numbers just do not bear out to such extreme pessimism. I mean, we had a reading on the put-call ratio recently. I think it was December 20th, was an all-time record high of 1.82. And if you look at a 10-day average or a 20-day average of the put-call ratio, I mean, that thing is as elevated as it has been in 10 years. So it's insane. And yet, as I've been saying in my reports and in my emails and also in these commentaries, you look at the fiscal support, which is unprecedented. You look at the labor market, which we see again today was extremely strong. You look at bank credit, loans and leases, etc., deposits, all the growth in those metrics, which have been re-accelerating since November. Now, that's important because since the end of September, the end of October, the stock market has been falling. So if the stock market was, if that sell-off in the stock market was kind of percolating through into the general economy as weakness, you would see loan growth really start to slack off. As a matter of fact, you would see contractions. What we have been seeing is not only a reacceleration in loan growth, we've seen all the loan metrics at all-time record highs. You didn't see that in 2008, 2009, 2007 when we went into that recession. So the data just did not support this sort of extreme pessimism that we saw in the stock market. We're not going to go into a recession. I've been saying that. Stock market is going to power much higher. And yeah, everything that I've been saying is on track. So that's it for today. Nice day. And talk to everybody on Monday. Bye-bye. Have a nice weekend. Bye.